Welcome to the second meetup of the AI Weekend. We have with us today Piotr. So Piotr will be talking about the use of AI in trading the financial markets. He's a self-employed retail scalper with 3 years of experience as a startup founder, 5 years as a software freelancer, and 4 years of personal trading. Piotr, the floor is yours. You can start with your talk. We look forward to hearing you.
All right. I just don't feel the floor, but whatever. So hey everybody, my name is Piotr Yordanov. In case you guys don't know scalping, I just realized it might not be clear. Scalping means it's not high frequency trading, but it's fast enough. So like my trades can last a few minutes and I'm done. Sometimes it's a few seconds. Anyway, so like during this talk, I'm going to be talking about using AI in finance. But I will not be speaking from what, let's say, hedge funds do, because I personally don't have experience in what hedge funds do personally. Like I haven't worked in the field. I do have information. But most importantly, I don't feel it's going to be relevant or useful for you in the audience because it will get pretty technical pretty fast. And if you don't understand financial terms, it'll just be very hard. However, what I'm going to be doing is speaking as a retail trader. And retail means, just a guy in his bedroom, doing his trading. And essentially that could be you, that could be anyone, because originally I started wanting to write bots that would trade for me. And I realized ultimately I need to understand how trading works before I can start doing that. So yes, just go here. Boom. So that's about it. I mean, my goal is for you to kind of know that even as a single guy, you can still make it in the markets, but just don't follow Wall Street bets and just YOLO your savings on GME. Just be safe. All right, so here's the content. I'm going to speak about market manipulation in the beginning. Then I'm going to talk about arbitrage and then speculation. Because I think a lot of people think about trading and think that the financial markets is all about predicting where the price of something is going to go to. That's not really it. This is only speculation. It's what I personally do for a living, but it's not what the big banks are going to be doing or even you need to do yourself. I want to start with market manipulation with this guy called Navinda, who broke the markets in 2010 in the flash crash, because it was one of the first instances where we had algorithmic trading cause an issue. So what Navinda did was quite interesting because he was a single guy in a bedroom in the suburbs of London, and he wrote a program that would essentially do something called spoofing. If you've ever done security, you actually know the term. It's very much the same concept where you flood the market with a lot of information. And so you put orders like saying that you want to buy at a certain level or sell at a certain level, but then you keep on updating the order over and over and over, and ultimately you cancel it. But when you do this, you create the feeling that something important is happening or some big whale is coming in. They're going to dump in their shares or buy a certain level. So you actually end up, in a way, manipulating others into getting into the market. And when they do, you just cash in on whatever they did because they're going to be left-handed holding the bag. And for him to do this, he had to write a program. And actually, he was writing the program to compete with high-frequency trading companies that were annoying him because they were doing stuff similar at the time, at least. As you can see here, the Dow lost on that day 1,000 points in a few minutes, literally, and then they gained it back. And 1,000 points is a lot. It's like $5,000 per contract. So it's a lot of money. So you can imagine, that was a big thing. And the guy eventually got into prison, I think. He got caught by the US government, etc. So what he did, and this is where, it can be interesting for you to look into, is essentially he was reading the order book. What I have in this picture is the price of Bitcoin that I happen to be looking at. That was literally a few moments ago. The price was somewhere over here. And what you can see on the picture was this spike over here. This is essentially telling me that there were a lot of orders sitting at $60,000. So if I'm just reading the order book and I'm seeing what other people are putting in there, so when I say me, it could be me myself, or it could be a program you're writing that is constantly scanning and looking for certain patterns that you would have written yourself. So when I'm saying this in the order book, I might say maybe I'll be buying at this level, or maybe I'll be selling, hoping to take profit at that level. So if, for example, you had sold at 60,600, that was the price, somewhere over here, you would have eventually made kind of money because the price did go to 60,000 minus a few ticks. So yeah, I'm just trying to give you an idea, and I hope that wasn't too fast and too much, but just to be a bit more clear, this is how the order book looks like. It's essentially saying that at a certain level, This is the amount of interest that people are saying that, for example, at 61,800, there's 110,770 contracts waiting to be sold. It's like if you're in Lebanon right now and you want to buy Lebanese dollars at something, you go to see what the price is. This is, it's kind of the same thing. We don't have an order book going for the Lebanese lira, which is horrible. So yeah, again, I'm saying this because this is something that you could either have a very dumb machine, like not machine learning, a very dumb program scanning for certain levels, like for certain big numbers. Like for example, here you would say, I see a big number here, I'll sell here, or I'll buy until we get to there, or here, wow, this is a big order that just came in. So maybe you'll say, I'll buy at this level, for example. Either you do this or you start adding something like machine learning or whatever your flavor of AI is to say that I'm going to be learning how to get there. I'm going to be teaching the machine how to get there. So this is one way where today you could be doing this. That was inspired by what Navinda did back in the days where that didn't really exist. So this is the first thing. Now we're going to something which is, if you're in crypto, you might have been familiar with. It's essentially pumps and dumps. Disclaimer again. If you do manipulation, spoofing, or pumps and dumps in the US, you'll be in federal prison. So I'm not saying you should do that. But I'm telling you, this is essentially what's happening because cryptos are decentralized. And that was, so what people would do, they would go on a Telegram group or a Discord channel, and they will start, at a certain point in time, they will start advertising a coin. Like here, they're advertising this magic coin. And so the idea is to get people to start buying the coin. But then, as you can imagine, they would just dump it, and it would just come in and crash. And if you bought low, you sold high, you're lucky. Otherwise, you're going to be left holding the bag with a minus 30%, 40%, if not even higher percentage of loss on the particular trade. But those are the kind of things where you guys would like to play with, natural language processing. You're going to have a blast doing this because it's not that straightforward. They put this kind of text and they keep on adding things so that they kind of avoid having bots doing that. But essentially, there's two ways you could profit from those kind of movements. Either you just know where the groups are and you just like try and ride the wave, or you could actually feel it from what the market is. Essentially, like from a pure technical analysis point of view, if you start noticing a certain point is suddenly gaining a lot of volume pumped into it, then maybe you want to try and catch the wave. This one though would require you to understand what the financial markets are doing and how to get on a certain exchange and how to put the trades and how to exit them, how to trail the stop. It's a bit more advanced, but you can still do some natural language processing, which you don't necessarily need to do only on Telegram or Discord. There is actually, if you were familiar with Wall Street Bets, it's this Reddit that essentially got GME very popular, and then GME started going to the moon, and there was a short squeeze. And so there are literally people who wrote some scripts that would put a certain, like they would watch which topics are most trending on Reddit, and accordingly they will have a ratio saying, all right, listen, tomorrow, for the past week, the most trending stock has been Tesla, for example. So that means, Wall Street Bets is interested, maybe I'll just buy some Tesla. And then again, I'm mentioning those examples because those are ways where you could try and spot where the wave is going to be and ride it. You could also do this on Twitter. Back when Mr. Trump used to tweet, it was sometimes it was quite manipulative. Sometimes it was a bit funny, but this is another way where you can use pure machine learning and natural language processing to spot for certain elements in certain targeted places to have an idea where the market might go. Another way where people do this a lot and it's essentially looking for economical news. So for example, those are more fixed in time. So just to say that, like, for example, should have had that prepared, but I don't. Like, for example, I can go and see that next week, like Chairman Powell, the chairman of the Federal Reserve, is going to be speaking at 1 a.m. my time, so whatever the US time is. That could move the markets. The CPI is going to move the market. Like literally by 2:30 my time, when the CPI comes out, you just see an insane amount of volatility. So those are like expected news, which again can be very algorithmically traded because you start noticing within a fraction of a second that the stock, or the futures, or the stock market, whatever, is going in a certain direction, and then you want to just jump in the wagon, make a couple of ticks or a couple of points, and you're out, or lose a couple of points. It can always go both ways. You gotta manage your risk, and this is not the part of the conversation. Okay, so again, this is something that can be done. Another thing is arbitraging, and I personally did it back in 2017, 2018. The point of arbitraging is, well, you might be looking for the price of Bitcoin today, and you might ask yourself, why the hell Do I have multiple prices? Like here I'm on Binance and I have 3 tabs, and this is the price over here. Okay. And I have 3 different prices for the same crypto coin. And even this one is like 66,000. Like, what the hell is going on here? But let's just focus on these two. I have this one at 64,400 and this one at 6,300. There's about $150 difference between these two markets. And so this is within Binance. If you know a little bit about cryptocurrency markets, you would know that there's a lot of exchanges, and the exchanges don't advertise the same price. I mean, they're close enough, but it's not the same thing. And the reason why that is happening is because markets are not actually centralized. So everyone is like advertising its own thing. And while you might think, oh, it's outrageous that it's not the same price, well, some people would think this is an opportunity to arbitrage. Like, for example, I'll be buying this one and selling the other one and trying to wait until the price converges and make a profit. This, again, is it's not a way of predicting what the future is, because you don't need to predict what the future is. When I was in Thailand, for example, what I would do, I would buy Bitcoin from a US exchange or European exchange, let's say at $10,000. I would move it to Thailand and I would sell it at 10,500, make $500 in difference, and then pay a couple of commission and fees to wire this back to my accounts. It was tedious and it was hard and it was, I won't say it was illegal, but it was, it was a bit tricky. But it was very manual, whereby what you could start doing, you could write a bot that would do it among different exchanges, because it would be waiting for small differences. Now, in the case of Bitcoin, what it did was big difference. It was worth it to do it as a human being. But ultimately, you could write a machine that would spot those differences and would trade it using certain algorithms in real time. And I'm saying this because that is something that might not be very profitable for you and I, because you're going to be making peanuts. And even if you were to make some money, the profit is going to be eaten by commissions, which you should be very mindful of. But if you're a big fund, if you're a hedge fund with billions of dollars, you essentially want to become a market maker, which actually makes it interesting for you to do this kind of arbitraging, which, without getting too technical here, means you are providing liquidity, which is great for me because then I can trade off of it and the books are not going to be very thin. But the advantage for you as a big company is that you would be writing high frequency arbitraging bots that would have good deals with the exchanges for the fees, maybe even no commissions if you have like huge volume per month. And then in an exchange, you will be just really eating very small percentages, but you'll be doing so many of them that, it just adds up. And another example I wanted to give you, this one being a little bit more technical, like for example, here we are seeing the euro dollar futures, which is at 119.17. And here I'm seeing the euro dollar CFD, which is 118.97. The two markets are not on the same exchanges. They're two different markets. And again, it's quite technical for me to explain what futures are versus CFDs are. But let's say that those two are different. Because they're different, there's an opportunity to maybe arbitrage the two. And to arbitrage the two over and over and over, you could do it with bots. So it doesn't need to be actually AI. And that's, I think, something that's important to know, that it's like AI in finance does not need to be crazy machine learning. It could be something as simple as aggression or something as simple as automating a process that already exists. So on the one hand, it's good because you don't need a lot of knowledge. On the other hand, well, you need a lot of financial knowledge. Otherwise, you won't really understand what's going on. Cash and carry. Yeah, I wanted to speak about this. Oops, sorry. But it's not a great example because, it's more of what the hedge funds are going to do. So to give you a little bit of an idea, what hedge funds might be interested. So hedge funds are the companies that take people's money, and they usually manage billions of dollars. So they have the resources and they want to make money out of it by investing in the market. There are some things they can do that, you and I will never be able to do by ourselves, but if we work for them, we could, So you could do something, let's say you take a big mall like Target, for example, in the US, and you would use satellite imaging to be able to see the evolution over time of the usage of parking spots. According to this, you could guess that, maybe Target is getting less visitors this quarter, so they would have less profits. So there's a high chance that the price of the stock might go down. This is very theoretical. I'm not saying it's going to happen. This doesn't need to happen this way. But, I mean, it seems to be easy to think that, with COVID, everyone is not going to Target. So, obviously it's going down. Another example could be looking at the history of Visa card purchases, to see what's happening with a certain retailer, like maybe with Apple, for example, if you don't have like inside data from Apple. And the point of getting this information before others is to be able to predict where the price might go before it gets there. By somewhere, this could be illegal if you don't do the right things. Like if you get the information from an employee at the company, that's illegal. It's called inside trading. But if you're getting it by just using your wits and brains, by following cargo routes in the sea, by following Visa card purchases, by following social media followers maybe, and doing maybe some prediction of what this number is going to be in the future, and correlating this with the performance of the stock, then maybe you could put a certain strategy and backtest it, and then try and make trading out of it. So again, this is a form of speculation that is it's a bit tough if you want to get in the market by yourself and have some fun. Maybe don't really do this unless if you're trying to do a side project. That could be interesting. So otherwise, what I have done personally, and what you could do if you want to start to have some fun with technical analysis, for example, is essentially backtesting. So just real quick, the black line is the price, the red line is the 10 moving average, and the blue line is the 30 moving average. And so the moving average is essentially the average of the previous X period of candles or price points I had in time. And we call it the moving average because it moves, So like this point is the previous stand, this point is the previous stand, etc. It keeps on moving. So as you can guess, the smaller the period, the closer you are to the price. Again, without getting too technical about how and why and whatnot. But the point is, assuming you get those two moving averages, one of the very famous strategies, which I don't like because it's very frustrating to work with, but I'm just giving you an example, is essentially whenever the two are going to cross, you're going to either buy or sell. And you might have heard, if you've ever been and reading the financial news, they're called golden cross and death cross, depending on which one is crossing which. So let's say you want to do this and you want to backtest it. So you use a program like Backtrader, which is a Python application, which we're seeing the output here. And then you would say, whenever they cross, you buy. Whenever they cross again, you sell. So if red goes above blue, buy. If red goes below blue, sell. So you're buying here. Oops. You're buying here, you're selling here, you're buying here, you're selling here, you're buying here, you're selling here. And essentially what you're seeing here is your performance. You're saying if you're winning or losing, this is a loss, this is a big win. Yay. And you're seeing where your portfolio is at. I think this portfolio is losing. It's not a great example. As I told you, I don't really like crossovers. But I'm giving you this example because you can start with something as basic as a moving average crossover in Python. And then you could start doing something fancier. Like, for example, I'm just trying to have this example here. Yeah, some people run Monte Carlo simulations because, all right, so here's the thing, and this is where things become a little bit more AI-y, is that, as I told you, this is a 10 moving average and 30 moving average, period. The question is, why did I pick 10, not 20 or 7 or Fibonacci number like 8? Why did I take a simple moving average, not an exponential moving average, which gives more weight to the most recent price action? I don't really know. I personally go with Fibonacci numbers because I am not superstitious. It's also a question of habit. I'm more comfortable with 21 and 89, for example. I don't know why, it's just whatever, I got used to it. But if you want to do something like optimization, what you can start doing is you would take this and you could run it through a genetic algorithm that will try and mutate your periods. It will try to mutate your original algorithm from an SMA to EMA to WMA to Hall MA, whatever, different kind of moving average formulas. And then you would try and see over a certain period of time which numbers, which periods give you more profit. The only issue you gotta watch with this is that you actually the same problem is gonna have in any AI problem. You might be doing overfitting, you might be biased by the data you're seeing. Like, I don't know, if you do history and you don't have COVID data in it, maybe when COVID happens, you just lose the account if you're not ready for it. I don't know, I'm just giving an example. So you'll be running through the same issues you'll be running if you're doing any other machine learning project in place. But just the data happens to be, in this case, it's technical analysis. What some famous funds have done was something that doesn't even use technical analysis. It's used something like mean reversion. And nowadays, I'm aware that like hedge funds do use machine learning. I just don't really know how, and I don't know if they're using technical analysis or they're using some more arbitraging techniques or etc. But that's the point. Like speculating and trying to guess where the price is going to be is not the only way. And most importantly, it doesn't really matter. On the side notes, where the price is going to go. What really matters is to make money. So I don't really care if I'm right in my analysis as long as I'm able to swim out of a losing trade without losing, and I keep on having a winning trade winning. Yeah, Monte Carlo simulation, and this is the automation. Oh, so here's the automation part, and that's where I'm gonna show you a little bit how I do things personally. So this platform is called Quantower. I'm not advertising it, it's just the one I use. There's a lot of them out there. It just works for me. A lot of the indicators I have here are indicators I've written myself. Like, for example, here, when I click the middle mouse, it shows me levels of interest. So if I'm going to sell at this level, I know where I'm gonna go, where I'm gonna add, I know where I'm gonna exit. And this is based on some automation I have in place in the background. It's very dumb automation. There's no machine learning what I'm doing, at least at this stage, because to be honest, I don't feel the usage for my own personal cases. It could be interesting with what I'm having over here. It's actually here I have a watch list in which I'm looking at a bunch of crypto coins. This right now I'm looking at the crypto markets, but it could be anything. I'm saying the crypto markets because it's open. It's a Saturday, these traditional markets are sleeping right now and they're like playing golf with each other. Cryptos are having fun. So what I do have in this column over here is a custom-made indicator that is trying to scan all the markets that are available, and it's trying to tell me, all right, look, for example, right now KNC is more interesting. So if I want to scalp, I'm going to scalp the KNC. Well, this is quite a bull market. I mean, quite a rise. So this could be very interesting to buy at this level, for example. So this part is automated because I can be scanning those coins every single minute myself. There's 109 of them to start with. It's a lot, and it's constantly updating. And it's using. So I'm using an indicator, which is using an indicator. So it's like always running. And so this is one way of automating. Another way of automating is if I'm going to put a certain trade, like for example, this is moving average. As I said, I like moving averages, but not as crossovers. If I'm going to trade on a certain moving average, I do have some routines whereby if I'm going to put a trade, it is going to, the management of the trade is automatic. And the point of it being automatic, and this is if you want to be a retail trader, you've got to be very mindful of this, is trading is not about making money, guys. It's about managing risk. It's about being consistent, being reliable, being honest, being disciplined with yourself. And so what's more important for me is, when I'm going to say this is what I do if I have that, when this happens, that I actually do what I said would happen. So if I'm telling myself I will take a loss at a certain level and this level happens, I need to take the freaking loss. If I don't, this is how accounts are blown. This is how people lose money, essentially. So I used to have an indicator that would actually do that for me, which now is just blend in other indicators, and it was called the guardian angel because I needed someone to save me from myself, and that was the guardian angel. And so the reason why I'm mentioning those is because today my style of trading is hybrid. I decide when to buy. Oh, I still want to buy here, so I just fucking I'm gonna buy. So I decide when to buy, but the decision of selling is more based on like rules in place. Once I start finding ways of automatically finding ways of buying, then I can run a bot and it would be just doing all those techniques for me 24/7. And maybe at some point, if I want to maximize this, I'll be running some machine learning in place. I shouldn't have put this trade. Sometimes I feel like trading feels like gambling, but you got to be mindful of that. I should be mindful of this. So yeah, I'll just close this trade, whatever. It's not the time to be immature in my stuff. So that's about it. I thought it would be a bit longer, but I speak fast. So let's put it this way. I know I spoke too fast, and I know I might have covered topics that don't make sense, or maybe you just don't know what's going on, or you want to dive in deeper. So I wanted to leave some room for that, for you to be able to ask questions, because I think this might be more valuable for you than me just talking for like 45 minutes. And that's it.
Thank you, Piotr. Thank you for your talk.
Sure.
This was really very interesting. So guys, if you have any questions, feel free to send them in the chat or in the Q&A. We will have a networking session with Piotr, like right after his talk. So we can go into a session where you can unmute yourselves, get to meet him, and ask him all the questions you want. But if you would like to ask him questions now, we will have a 5 to 10 minute Q&A session. So feel free to drop in your questions in the chat if you'd like to. Okay, so we have some questions in the stage Q&A. Okay, so Aisha is asking, okay, I think it's a bit different from what you were asking about. So she's saying that they are not very much related to the financial field. So I'm going to keep these till the end, Aisha. I'm sorry. I'm just going to ask the question. Someone said, for an individual, is it better to automate trading or just buy into an index?
Neither and both. It's like the worst answer I could give you. Look, let's put it this way. What I would tell you to be mindful of is the word better. There's no such thing as better really in the markets. There's a lot of things that I need to know before I can ask the question. Like essentially, what's your risk profile? Do you have experience trading? If you want to trade, are you scalping like I'm doing, or are you looking for long term? If you don't have any experience in the markets, generally speaking, it is safer to just buy into an index or buy into, and you could do cryptos, but they're like a bit dangerous. As in, like you can make a lot and you can lose a lot. Like if you bought crypto at $20,000 in 2018, that would have been painful. Buying index are safe, like as long-term investments. You just need to not freak out when they crash and just think that this is going to be a 20, 30 years thing. Automated trading is hard because if you don't understand trading, you will not understand when an algorithm doesn't work. I spent almost 2 years trying to automate trading until I realized, what the hell am I doing? Like, I don't today. It's almost funny when I look back at what I was doing, because the rules I was putting, like the example I just gave you over here about like this crossover. Now I know it's stupid to do crossovers. There's actually something more interesting to do. Like essentially, you want to buy here, and you want to buy here, you want to buy here, you want to buy here, and essentially you just maybe add here or something like that. I didn't know those things before until I started trading myself. So automating trading is interesting if you have understanding of trading. It's like if you want to automate trading, literally think of it this way. It's like saying, I want to automate heart surgery, but I've never done medical school. It seems obvious. No, you're not going to do that. But it's the same thing in trading, because trading is not the get rich quick. It takes time. You know? So anyway, I hope that answers the question.
Okay, thank you, Piotr. Someone is asking, Mark actually is asking, do you buy only for a few days and for long term, or for long term?
Personally, I don't. My style, and you should again, it goes back to the previous question answered about automation or index. You should understand your style and your way of doing things. I am impatient, and I know this in myself. So if I'm going to buy something and I'm going to hold it for 24 hours, I'm not going to sleep well. I've done this before. I held Bitcoin in 2018. It was very depressing for me. So what I do today, I just take quick trades, and it lasts me a minute or two. So I mean, this is what I was gonna do by buying at this level. So if I bought here and I sold at 1 ATR, would have been here. This would have been a minute trade or 2 minute trade, and I'm done. And again, this is my style. You need to be comfortable with it. I'm doing 1 minute charts. Some of my friends do 5 minutes. Some other people just do the hourly or the 4 hourly. What it means is that it's going to take longer, and you're going to have less signals. It's going to be slower. You will make less profit for sure, but you will make a lot of small trades. So yeah.
Okay, great.
So yeah, for you, there's a long term. Yeah, I don't do long term. No, not yet. At least getting into that.
Okay, so someone is also asking, how much has AI helped you manage psychological risks related to trading?
That's a very good question, because the core of trading is psychology. This is really what it is. Like the moment I started managing my own psychology, and I started being okay with losing and being okay with winning, and I started, if I'm winning, I don't get too euphoric. If I'm losing, I don't get too depressed. So you want to manage fear and greed. This is the hardest thing. Getting a system that works is relatively easy. Some of the setups I use are 2 years old in my dictionary. But psychology is the hardest part. So you remember I mentioned during the talk something about the guardian angel. Um, I'm just laughing because this is from League of Legends, in case there's some players over here. Yeah, that's where I got the name from. When I added the guardian angel, it actually did switch my perspective, because what DGA would do is that it would force me to close a position after a certain rule is met. So like if I'm entering here long and the price goes to this level, maybe 10 points away, it will kill it for me. And what this did is similar to as if I was trading and someone just patted me on the back. And it's like, we're done. You're done. Just leave. I'm closing it for you. And when that happened, it got sound weird, but it gave me a relief. Like I'm on a losing trade. I lost the trade. I closed it, so I realized the loss. But I'm so relieved, because now instead of spending the next hour hoping and praying to get out of the trade, and sometimes not getting out of the trade. And in some cases, it happened to me, I would just blow the account out of a single trade. Instead, now I have a clean slate and I can be less biased, if not at all, and ask myself, okay, maybe my long was wrong. I should have been short. So I'll just switch. So psychologically, it gives an edge in that sense. Also, doing it the other way around, where one of the biggest issues when you're writing a program is you want to try and tell it like when to take a loss. Sure, that's relatively easy. There's a lot of ways of deciding this. But the other question is like, when do you take your profit? And I spent a lot of time being a perfectionist, wanting to maximize the amount of profit I was getting. Until when I was writing the bot, I thought, if I'm getting here, I will just go one-to-one. I'll take my loss here and I'll take my profit there. And that insanely changed my way of looking at the markets. I realized I don't care to be making big runs. Like, you might think that you missed the Bitcoin bull run right now to $60,000, but trust me, it doesn't really matter because there's always going to be an opportunity somewhere else. And when you start like realizing you just want to make quick bucks here and quick bucks there and quick bucks there, at some point it just becomes a question. It almost becomes like a game where you're just like sniping here and sniping there and taking some profit here and some profit there, and you're no longer missing out anymore. And those two things have, ironically, is writing those scripts to save myself from myself that had this very positive result. So it's actually a nice question. I appreciate that.
Okay, so thank you for your reply. Someone as well, Yusuf, actually is asking, in the AI bootcamp that we've held recently, they built a model for fun. In 3 hours, they built a machine learning model to scan social media and predict volatility in a company stock with 78% accuracy to do straddle trades. Do you think that would be good to continue with?
I'm not sure I understand what you mean by straddle trades. Are you talking straddles and options, or do you mean something else? I'm wondering if Yusuf could clarify that, just so that I don't answer it correctly.
Yusuf, maybe you can send it in the chat. In the meantime, we have as well a question from Shara. Is there a predefined tool that predicts the interest rate?
Is a predefined tool that predicts the interest rate where it's going to be?
Yeah.
A crystal ball. No, it's like, again, when you say predict, you're talking speculation. We're talking speculation. You need to be aware that even I and the best traders, we don't know where things are going to go to. So predicting, it's not really a tool. If you're talking about US interest rates, you could be looking at when the next FOMC meeting is going to be. So when the Jerome Powell is going to speak next. And usually there's a feeling already before the market gets the news where the news is going to be at. Sometimes there are surprises where it goes the other way around. That's possible. And in this case, the market becomes very volatile. But otherwise, I'm not aware of any tools of trying to predict interest rates. And to be honest with you, I don't really care because I don't trade. So interest rate is fundamental, and I don't trade fundamentals. I try to avoid doing that for a simple reason, not because it's wrong. Some of your friends do fundamentals, that's perfectly fine. If you like it, again, it has to match your style. But the reason I don't do it is because if for some reason the market knows it's going to be bullish, sometimes you sell the rumor, you buy the news. Right before the news, the price is dipping, and right when the news comes in, it flies off. I don't really know. I don't really care. All I know is that if I start seeing lots of volatility, I have strategies to just ride the wave. So what I'm trying to say is that whether the news is interest rate, whether it's COVID, whether it's like something blowing up somewhere in the world, eventually the markets are going to react either up or down. So I don't want to understand or assume what a certain event is going to do, because sometimes it could just feel like a coin flip, at least again for me. So yeah, I'm not sure I really was helpful in answering this. Yeah, I saw Yusuf said straddle and options. Hold on, let me just repeat the question. Straddle trades. I guess that would be interesting. I don't personally trade options, and to be honest with you, I learned about straddles just a few weeks ago. I trade futures. I prefer them. They just habits. That's all. Just habits. I would just say, just because you had 78% accuracy in 3 hours, I would only tell you this is great. It's a great start. Be mindful that don't get overly cocky and confident because you had positive result that it's going to work. And always tell yourself, and I'm not telling you just to be just skeptical and say, no, it's not going to work. Just be cautious and don't be reckless. You need to take this into production. That would be the big question. Like, how are we going to automate it with which broker? What are the commissions? What are the fees, etc.? But yeah, if you're getting 78 accuracy, you might as well do it. Also, maybe one thing you want to watch out for is, I don't know how you were, like what kind of data you were working with, but if it was in a single company, you might be biased. So you want to try it on multiple companies, maybe you want to try it on multiple markets, multiple different conditions. Are you able to go back as far as 2008 or 2001 or even all the way to 1929, for example? Like if your strategy still works in those environments, then it's great. I mean, it would be a freaking lucky shot to do this in 3 hours. Some people spend a lot of time doing that. But yeah, absolutely. Most importantly, I would say just to continue in this field, you gotta love what you're doing and forget about the money. Money just ruins the mindset. That's all. I mean, you make money at the end, but it's the byproduct. It's not the goal.
That makes
Yeah.
sense.
I saw the other question. If I had to start again, what would I do differently? I would start by learning what the markets are. I think, yeah, actually, just to rebound on what I just said, I would not think about the freaking money, not use any other big F words. Like, think about the money and the very feeling that I had to pay rent from my trading, for example, was very, 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 very stressful to the point where you just become be biased. One example is, for example, that I would be thinking that I need to have this one big trade and I will become rich. Like this is a big problem that comes from the idea that you have to be right. You also need to understand things. Again, I'm talking if you're going to be trading first of all as a retail trader, and if you're going to go in machine learning and AI. I just feel you still need to understand how the financial markets work. You need to also understand the psychology because you see the psychology of fear and greed in the markets like all the time. It's always present. Um, and so what I wanted to say is, yeah, for me today, it's much more pleasant to take quick trades. Like I opened, in the middle of the call at the talk, I opened my trading platform and I just went to my indicator that tells me what is the most volatile right now. And I saw a potential setup and I could have taken it. And if I take it and I make some money, I'm happy. If I don't make money, it's fine because the next trade is going to be in the next 10 minutes and then the next 10 minutes, and etc. So I would say removing the money aspect and the need to make money would be very important. And think of it this way. Like if you think of the best surgeon, I love using medical examples because this is really how trading feels. Like imagine you have the best surgeon in the world. Do you think he ever became good at surgery because he was going to make a lot of money out of it? I mean, he's making a lot of money out of it because he's the best surgeon in the world. But was that his motivation? I mean, most likely not. And even if it was, he would keep on doing this for the money. I mean, once you have the money, what do you do next? You just buy a boat, buy a house, and then what? Like, do you still go and do the same thing because you might not necessarily like it just because there's the money? So it's on the one hand, it's important to just put the money on the side, but also understand that because it's about the money, a lot of people get in with the money in mind. And so it plays in the psychology, whether those people happen to be retail trader like you and I, or it happens to be big banks and big companies, same thing, you know? So be aware of it, but be mindful of it. So that's what I would say.
Okay, we have a few other questions. So Manuel is asking, what is your go-to book for basics on scalping and how ML is incorporated into your style of trading? And how do
Wait,
you suggest we start in this line of work? So it's in the event tab in the Q&A.
okay, event Q&A, all right.
Yeah.
I would suggest we start in this line of work. Hold on, let's go to books for basics on scalping and how ML is incorporated into your style of trading. Those are like two questions. Like scalping is one thing, and ML is different thing. Okay, let's put it this way. Scalping is the definition of scalping is the time frame you're using, which would be minute charts or tick charts if you are in the futures markets. Really, my strategy does not care about which time frame I'm using. I would apply the same strategies on a daily chart, on a weekly chart. I would apply it on a historical chart from the big crash, like the Great Recession, etc. Because there's a concept of fractals and the repetitiveness of the markets because the same players being fiery and greedy at the same time. So if you want to go into scalping, that's one thing. If you want to do it manually, I would say psychology, meditation, just work on yourself. Realize that you can make your day at work in 30 minutes. And that this is a problem because we're not used to this. We're used to working from 9 to 5. So, and I'm not joking, but sometimes when I would make my day in a few minutes, I would feel unworthy of having it. So I would give it back because, let me see, it should work 9 hours like everyone else. So you gotta be aware of psychology. If you're doing it with the machine, again, I think it's important to understand what trading is. And those would be two different books. Like for scalping and for psychology, Mark Douglas, Trading in the Zone, and The Disciplined Trader are great books. It took me a while to really appreciate what they were saying. If you're talking about machine learning, you would want to look at books that dive into quantitative trading. I don't really have any references because I haven't necessarily used it. Because there are people whose job is to build machine learning algorithms for trading, and they don't necessarily understand trading. Because usually what happens to those big companies is that you would have a person researching a certain strategy, and you have someone else implementing the machine learning, and then someone else implementing execution. But those are really different jobs. So just try to be, maybe you could put yourself as a target to be working in such a big company in the future, but at the beginning, get to know what the markets are, get to know the difference between futures contracts, options, derivatives, forwards, etc. Know a little bit about technical analysis for fundamentals, maybe know a little bit of history, I guess. And how do I suggest in my line of work? Again, if you want to do it manually, Manuel, I would say if you want to be a retail trader like I am, essentially not working for someone else, just doing it with your own money, one of the mistakes I did for a while was not having a source of income. So if you do have a source of income and trade on the side for fun, like keep it for fun, right? Like, because that's the best way to learn, because you will make mistakes at the beginning. This would be a very great way of starting up, because you don't want to, like when Corona happened, I blew an account. I lost an account in an hour, literally, just everything disappeared and vanished. It took me 2 months to recover from that. Now I'm fine. Now I even laugh at it. It's actually even cute how it happened. But it's hard. It's like very hard to have the mental capacity to go over a slap in the face. That was even more than a slap in the face. You will feel like a train is just going through you, and there's nothing you can do about it. So you need to be equipped psychologically. And one of the safe way would be to just have some savings, or just have enough that you don't have to worry about things, so that if you lose the account, you'd be like, whatever, it's okay, I'll come back next month, So that's for it. So Rebecca, I see, she says, how the blockchain technology is applied in the financial markets. DeFi could be a way where it could be very interesting to have some DeFi or even a blockchain in the financial markets. This would avoid a lot of the fraud we've seen, like the Kerviel case in 2008 that actually sank almost City.AI here in France. And the cool thing about blockchain is that it's transparent, and you can't really do any fraud on it. Like whatever goes on the chain is on the chain forever, unless if you're PCH. Yeah. So this is where it could be applied, for example, where between banks, to avoid having issues inside of the bank. It's great. Ripple, if I'm not mistaken, is being used today to do settlements between banks, which would be great, because if you ever done a wire transfer internationally, it's 5 bloody days for when crypto takes 10 minutes. Like, why? Why does it need to be like this? We're getting there. Hopefully we're getting there. So this is how the technology of blockchain can and probably should be applied in financial markets. Insurance is also a way, like in DeFi, we've seen it, and that was stopped at some point. So yeah, I hope that answers Rebecca's questions. Okay, that's the interest rate tool. Okay.
Yeah.
Is there more questions on the stage?
Yeah, I think we're done with the questions. Maybe we can move to the networking sessions if you would like to discuss further these talks. We can go now to the sessions, guys. There's a session called Networking with Piotr, so you can join us there. Thank you, Piotr, again for your talk, and thank you all for your interaction.
Thank you for having me. All right.
See you there.